All right, tough day for the NASDAQ. Of course, these big tech names came under serious fire in the Capitol Hill and also from each other. You know, it seems like every day now we're greeted by news of one of these big tech names going into someone else's turf, right? This week, Amazon going after online business of Facebook and Google. And then this morning, we hear that Apple bolstering its online content investment, and that sent shares of Netflix lower. Now, the great news is the broad market did not fall apart without big tech, and this is what we want to see. A lot of the buying defensive or value, that propelled utilities, real estate, also consumer staples. And I've been asking you guys and talking on this show, make sure in your portfolio you have some exposure to certain consumer staple names because I think tech is going to become more selective. And then I wanted to talk about this. I got an email today from a guy named Tim. He says, I think the market isn't going higher because people are having a hard time trusting their money to what really are petulant children, tariff this and that. That's the only thing that matters, but it isn't. It's all the market cares about. Wall Street is the swamp. Part of my reply to Tim is I said, please don't confuse the market with market commentators. 3 of the 4 biggest hits to the market this year all were in response to Fed policies. In fact, the biggest hit that was related to tariffs was on March 22nd. The low of the year was March 23rd. Since then, the Dow's up 10%, S&P up 11%, NASDAQ up 14%, and Russell's up almost 14%. So don't let commentators, even those who are really genuine whenever it comes to critiquing the government policies or actions, dictate your investment and certainly your financial future. I brought 2 of the best to talk about it. Shah Gilani, editor of Capital Wave Forecast. Robert Wolf is back with us as well. Shah, it's been a long time. I'll start with you. People, it's really tough because you have your natural anxieties anyway as a would-be investor, particularly if you're a novice. But then when it feels like almost all the news is bad news or warnings, you just don't get in there.
I think that's a mistake. I mean, it's easy to have trepidation about getting into this market, especially at the highs and continue making new highs. But it's sort of like waiting for a meteor to hit the earth and say, I'm not going to do anything because at the end of the day, there's not going to be another day. That's a complete waste of time. This market is going to continue to go higher. The economy is hitting on all cylinders. Productivity growth is good. The GDP growth is above 4%. I think it might, probably smooth out a little bit there, probably to the mid-3s. But that's still outstanding growth for a very mature economy that the United States has. The labor markets are strong, so there's nothing to do but get into this market. The earnings are fantastic. Right. They're hitting records. So to not be in this market is a complete mistake. Anyone on the sidelines is hurting right now.
Robert, you help long-term investments, right? I mean, you raise money for companies and you help dreams come true. So you do that through all kinds of political upheaval, no matter what.
Yeah, I would say, listen, I'm nervous about the markets, but for fundamentals with respect to what the Fed may do, with respect to a bit of a protectionist environment, and with the idea that tax reform really pushed, I think, a lot of the good news forward.
The sugar high.
The sugar high. That being said, I would agree with Shah and yourself, Charles. We need to discount the noise in the system. Everything we read is so polarizing. Hate this, hate that. Left is not good. They're bad people, right's worse people. I mean, at the end of the day, I think the markets are telling you that people want to actually invest in companies, that companies are doing really good work, and at the end of the day, they're improving. And that's a good growth scenario. That being said, we have not been in an environment in a long time with a Fed rate hike environment, and that's where we're going.
Are you confident, though, because it feels to me that this new Fed chairman, he kind of gets it. In other words, he has signaled to Wall Street last time in Jackson Hole that he will try his best not to derail this.
I'm not confident because at the end of the day, we're going to have a lot of rises continually over the next year and a half, and the fiscal deficit's not going to feel too good. So I think from that perspective, and let's be honest, we're in a chaotic political system.
Sure.
If the Dems take back the House, we're going to be in an impasse between the executive branch of Trump, President Trump, and a Democratic House for the next year and a half to 2 years. So I'm nervous about other things, but for the companies. I think the companies feel really strong.
If I could just jump in on the Fed has engineered this recovery out of the Great Recession. It's engineered the markets going higher because of the wealth effect that they wanted to create, which is make the economy look better, actually make it grow, make the stock market look better so folks invest. Consumer confidence is great, investment confidence is great. They are not going to do anything. They're not going to raise rates precipitously and blow the whole wealth effect that they've taken going on to 10 years to create. It's not going to happen.
Well, I hope they don't pull away the punch bowl because Main Street gets a 3% 30% year-over-year raise. Of course, that's going to be the red flag on Wall Street. I just hope they don't do it. And to your point, Robert, I had a hard time getting conservatives to invest during President Obama's presidency, even though the market had the second worst sell-off in history.